Hello, this is Ann Jones, Webcast Manager at PRMIA, and I am pleased to welcome you to this PRMIA webinar. Today, John Gregory will present Counterparty Credit Risk and Credit Value Adjustment, the continuing challenge for global financial markets. This webinar is sponsored by Bankers Acuity. Dr. John Gregory is a partner at Solum Financial and specializes in counterparty risk and CVA-related consulting and advisory projects. He has worked on many aspects of credit risk in his career, being previously with Barclays Capital, BNP Paribas, and Citigroup. He is the author of the book Counterparty Credit Risk, The New Challenge for Global Financial Markets. John holds a PhD from Cambridge University. Please feel free to submit your questions to John via the question pane on the right-hand side of your screen at any time during the presentation. Questions will be read by PRMIA's Director of Education, Alex Voicu, and answered by John at the end of the session as time allows. Winners of the random drawing for 3 of John's books will be announced at the end of this webinar. Following this webinar, a link to the presentation will be emailed to you along with the link to the recording of today's webinar. So now, John, I will turn this presentation over to you.
Thank you very much. This is John Gregory. I'd like to thank PRMIA for organizing this webinar and inviting me. I hope that in the next hour or so I'm going to tell you some things around the topic of counterparty risk and CVA, which are going to be interesting. I hope you're going to have some interesting questions as well, and also you're very welcome to contact me. My email address is on the slides, so if after the webinar you want to contact me about anything at all, then please do so. We're actually going to start with a quick poll question. I'd like to just gauge what the experience of the audience is around this subject, and I better define what I mean by these 3 terms, A, B, and C. So I would, for a novice in this area, I would suggest that someone who's pretty new to the area knows what we're talking about, broadly speaking, but doesn't have too much technical expertise and has only maybe been looking at this for a very short space of time. Intermediate would be someone who's maybe been looking at this subject for a year or so or more, but not necessarily super advanced in this area. And of course, advanced, I would consider someone who's more than that, has a lot more experience in this area and has been looking at this area for more time than that. So I'll just pause, and it'd be great just to get a breakdown of where we are with regards to the audience.
Okay, I will launch the question now, and you have 10 seconds to answer the question. And I'm going to share the polls now. We had 51% that were novice, 41% intermediate, and 8% advanced.
Okay, well, thanks very much. I'm not sure that's exactly what I guessed, but I guess that's not a surprising breakdown. So I'm not going to assume people know too much about this area. But obviously I am at times going to touch on some more technical aspects. So I hope those of you who are novices are not going to feel like I'm going over your heads, and those of you who are intermediate or even the few that are advanced are not going to feel this is too simplistic. I'm going to split this into 4 sections. The first section, I'm just going to talk about why CVA and what we do around CVA. And then we're going to talk about how complex CVA is. I'm going to spend then a reasonable amount of time talking about one of the key regulatory aspects, CVA VAR, and then finally I'm just going to have some thoughts at the end. I'm not going to talk about maybe the hottest topic, even more hot than CVA at the moment, which is FVA. I will mention it briefly at the end. Obviously that's a topic that's gaining a lot of interest at the moment and probably requires at least one other webinar by someone, probably more than one webinar. So I'm going to stay clear of FVA given we don't have too much time, but as I say, I will mention it very briefly at the end. So why CVA? Let's start from accounting rules. IFRS 13, which comes in next year as an accounting standard, says clearly that an entity must include what we could interpret as CVA in evaluation. And indeed, IFRS 13 also requires that DVA is accounted for as well, DVA, a lot of people will know now, is the component of counterparty risk that relates to an entity's own default. And it's rather controversial, as you might gather, because obviously you might think, why would we have value from defaulting? But there are circumstances by which you can show that DVA is real and can be monetized, although there are many people who have suggested that it is at best maybe a bit dubious. And in fact, I'll ask a question about that later on in the webinar. So basically, accounting standards next year are saying very clearly that you must account for CVA and indeed DVA. You may ask, well, has that changed? Didn't accounting rules already state that you had to account for CVA and DVA? And the answer is, it hasn't really changed. You already had to account for CVA, and depending on where you were, you had to account for DVA as well. But I think there are two important things. One is the treatment of DVA between different accounting standards varied. So that led to a landscape where European banks tended not to use DVA so much, whereas US and Canadian banks, for example, had to use DVA pretty much. And there was also the situation where the interpretation of accounting rules was rather different, to the extent that there are banks out there that don't account for CVA and DVA at all. It is just zero. They do not calculate it. I'm not suggesting they are very, very large banks, but that's still the case. There are banks out there that account for CVA and DVA in rather different ways, and IFRS 13 is going to change all of that. And there are also, apart from what IFRS 13 actually says, there are rumors around that it will be used as a way to force people who didn't comply with CVA requirements before to do it now. It won't be necessarily that the rules have changed with regard to CVA, but just that it's a good excuse to force that change to happen. So accounting rules are a big deal for CVA and DVA. Another thing that's, of course, a big deal for CVA and DVA is regulatory requirements, in particular with respect to the Basel III capital requirements around counterparty credit risk. In December 2009, there was this very, very key statement that you see here, which is that 2/3 of counterparty credit risk losses were due to CVA and not due to actual defaults. And the reason that was so critical was that CVA wasn't being accounted for and certainly wasn't being capitalized at all. So basically, 2/3 of the capitalization of counterparty risk was completely missing, according to this initial document from the Basel Committee. So banks will be subject to a capital charge for potential mark-to-market losses, i.e. the CVA volatility, and that capital charge, as we'll see later, is going to be a very, very big deal. So irrespective of accounting rules, there's going to be a very significant capital charge against counterparty credit risk in the form of what I will call CVA VAR, because that's precisely what it is. It's capitalization of the volatility of CVA, so it's the VAR of CVA, CVA VAR. Finally, on this slide, just note the bottom bullet point that Basel III do not allow you to do not allow you to consider DVA when you calculate your capital requirements for counterparty credit risk. So already we have a very, very big split between the accounting standards we talked about just now and the capital rules that we're talking about currently, which is that accounting standards say DVA is mandatory, you must account for it, and yet regulatory capital rules appear to say that DVA must be completely ignored. So on the one hand, DVA is completely correct, and on the other hand, DVA is completely wrong. So it's very important, of course, to try and understand a little bit more about what DVA is and why we're in this situation where, from an accounting point of view, you do consider it, and yet from a capital point of view, you don't consider it. So partly this leads to part of the broader issue that I'm trying to explain here, which is that it's not just a question of CVA, calculating our CVA and our DVA. It's the fact that we're probably going to have at least 3 different CVA and DVA numbers within a bank. In fact, there is a joke that goes around that says if you ask, I think it's if you ask 5 different banks for a CVA number, you get about 15 different answers, which presumably reflects what I'm saying here. What would be the different CVA numbers you could come up with within a bank or an institution? Well, first of all, you could come up with your official accounting CVA for books and records. Secondly, you could come up with the CVA as seen by the front office, which is normally the CVA trading desk. Not all banks have a CVA desk, but okay, the front office have some assessment of what they think their CVA really is from an economic point of view. And finally, you have the regulatory CVA, which is the formula that the Basel Committee tell you you must define your CVA as when you calculate capital through CVA VAR. And it is difficult to align those 3 CVAs. In fact, it is pretty much impossible to align the 3 CVAs. The reason it's impossible or difficult to align them is that you may use differences such as using historical or risk-neutral calibrations. For capital purposes, there is a requirement to use stressed market data for your calculations. There is an alpha multiplier if you're using IMM models. And basically, the regulatory CVA therefore is becoming very driven away from your accounting and your trading CVA. So obviously, the large banks are looking to have more of an alignment here, but the alignment is imperfect, and it's a question of how close can we make these numbers be, because obviously if these numbers are completely different, then we make a decision for one reason, and it has an unintended consequence, such as we make a decision to try and minimize the volatility of our CVA by hedging perhaps, and yet our capital goes up. Or we try and reduce our capital, but the volatility of our CVA goes up, and we have to try and decide, well, which one of those would we prefer? And of course, ideally, you would be in a situation where everything was aligned, and you know that if you're hedging and reducing your volatility of CVA, then indeed you will also be reducing your capital requirements, because that makes complete sense. But unfortunately, that's not the case. We can improve that, but we can't ever get, at the moment, to a situation where these 3 things are perfectly aligned. So the impact of regulation is, of course, as I'm sure everyone knows, going to be key. It's going to be key through Basel II, which was already around, of course, although, for example, a lot of US banks are still under Basel I, not Basel II. Basel II, there are a number of changes that have come about since the crisis, such as the need to use stressed market data when you calculate your CVA effectively, such as the need to consider different aspects for collateral purposes, and such as the need to consider wrong-way risk, which we'll talk about later in more detail. And under Basel II, so-called IMM approval, which is essentially the internal model method, so you have approval to use your own proprietary models to calculate your capital for counterparty risk. IMM approval has become more important because, of course, capital is expensive if you use more simplified versions of formulas for capital. But under IMM for counterparty risk, that's not necessarily the biggest issue. But I would just point to another issue here, which is that even if you had a much more simple capital regime that didn't require you to hold a lot more capital, you come back to this problem of misalignment, where you may have a capital you don't think is much more expensive than with a more sophisticated approach, but you will have a misalignment that you will be trying to hedge or do something to minimize your risk, and yet you will be increasing capital. And that misalignment is another reason, other than the obvious ones, why a bank would seek to get IMM approval over counterparty risk so they can compute their exposures and their CVA in a reasonable way and account for all the aspects they think are important without having to make use of simplified formulas from the regulator. Secondly, as I already mentioned, CVA VAR is going to be a very big deal. And you can guess it's going to be a fairly large number because the Basel Committee made it clear that they think 2/3 of counterparty risk losses are not capitalized, and therefore CVA VAR has got to take up this 2/3. So that's going to be a very important point. And this point I've highlighted here, which is that this appears to suggest the uncertainty of CVA is twice as important as CVA itself. That might sound like a strange point to some. Well, that's precisely what's being said here. You do get capital relief for CVA VAR from hedging, and I'll look at some examples later. But you don't take into account DVA, as we mentioned earlier. So this leads to a situation where banks that would not normally think about hedging their CVA will be incentivized to hedge because of the capital relief they may get. And so therefore a more active management of CVA will become important. The final point, which again I won't touch upon today, like FVA, it's another subject and it's a quite controversial subject, is central counterparties. A central counterparty makes, in some sense, the derivatives market look a lot more simple, as you can see from the picture at the bottom there. CVA essentially disappears when you centrally clear because the central counterparty is now your counterparty, and surely they can't default. And indeed, there are potentially smaller capital charges to incentivize moves to central clearing, and indeed, on top of that, there are going to be requirements under Dodd-Frank and the like to centrally clear certain trades if you are a certain counterparty in a certain place. So you have no choice over central clearing. But what about the risks of the CCP? I'm sure everyone on the line is happy to identify that even a central counterparty is not risk-free, because of course no one is risk-free. That was surely the one simple lesson of the crisis we've been through. But it's a bit more complex than that. You don't just have to believe that a central counterparty is risk-free. You can incur a loss when you trade with a central counterparty if another member of the central counterparty defaults. So if you look at that diagram in the bottom right of your screen, maybe I'm counterparty A and counterparty D defaults. The CCP is fine in the long run, but I still take a loss through what's called my reserve fund or default fund contribution due to the default of D. So the CCP didn't default, but I still took a loss, and that loss indeed has to be capitalized, not surprisingly, and that loss represents some CVA as well. And banks, I think, are increasingly thinking that there will be CVA to CCPs as well. So it's not clear whether the central clearing story will actually help or hinder this process, because on the one hand it appears to get rid of CVA, but on the other hand, I've just argued we still have some CVA, and indeed you can probably recognize from the graph, from the figure on the bottom right-hand side, that we have a fairly huge too big to fail problem with the CCP, which a lot of people have identified. Clearly, if the CCP fails, we have a very, very large problem. So that's what CVA is all about and what's happening and why we need to explore it in a bit more detail. Let's now think a bit more about the complexity of CVA. CVA is very, very complex. I've tried to write down the simplest formula I can here, which does indeed make CVA hopefully look a bit simpler. I've already had to make two fairly key assumptions, which we'll touch upon later. First of all, let's assume there is no wrong-way risk. I'll talk about that later. And also let's assume we can't default, so we're not assuming DVA yet. And in those cases, this is the sort of market standard CVA formula, if you like. It involves my exposure, which is what I expect to lose. It involves my default probability, which is how likely my counterparty is to default. And it involves a recovery value, which is what I might recover if the counterparty does default. And if I can characterize those three things, then I can characterize CVA, and that all looks relatively simple. But of course, those three things are not particularly easy to characterize. First of all, if we look at the exposure part, what appeared as EE in that formula, which we often know as credit exposure or simply exposure. Exposure is what you would lose if a counterparty defaults, and it is therefore the maximum of the future value of trades you would have with that counterparty in zero. And that optionality you see there arises from the fact that in default, you cannot make a gain if a counterparty defaults. You can't get away with not paying them what you owe them, but of course they do get away with not paying you. That's the whole point of why they're in default. So if someone owes me 10 million and they default, I don't get paid. If I owe them 10 million and they default, I still have to pay them, generally speaking. And so therefore exposure is derived in that way. That straight away implies we have optionality in our exposure. And of course optionality is hard to price compared to pricing the underlying. Secondly, we have to consider netting. Netting is very important because it allows us to reduce risk by offsetting the value on opposite trades. So in the most simple case, if I unwind a trade, I would have two trades sitting there. One is plus 10, one is minus 10. netting would allow me legally, if the counterparty defaults, to effectively offset one with the other, and that reduces my risk. In the more complex case, maybe I've done two swaps in different currencies, and netting allows me to offset those two swaps if the counterparty defaults. But now I have to ask myself, what would be the correlation between those two currencies? That's important in terms of driving the netting benefits. So correlations are now important, just like they are in a VAR framework. And just like a VAR framework, we're going to end up with a lot of correlations, potentially. And we could indeed have some rather unusual correlations, like the correlation between an interest rate in a currency and the price of oil, which is not a correlation we probably think about too often, but it may naturally be required because it's part of the netting problem. And finally, we have to look at collateral. Collateral reduces exposure, of course. Well, generally it does. Occasionally it can make things worse. But collateral can reduce exposure, but we have to know how much our exposure would be reduced by. And in particular, that is very subjective. One of the main reasons why it's subjective is we have to think of what is often called the margin period of risk, which is basically saying, if your counterparty were to default, how long would it take you to close out the trades? And also, how long would it have been since they last posted you collateral? And that's often assumed to be 10 business days. We'll talk a bit more detail about that later on. And of course, you may not think 10 business days sounds right. You may think it sounds like it should be longer, or you may think it sounds like it should be shorter. But that's the whole point. It is a rather subjective number. Under regulatory capital rules, 10 business days is a minimum. In certain situations, it could become, under Basel III, 20 business days, or even more than 20 business days, to reflect the fact that taking collateral is quite a difficult thing, and in particular when a counterparty is on the way to default. It might be the one time where it's very difficult to get collateral, and obviously that's the only time you actually really do need it. So basically, if anyone's from a risk management background and knows VAR very well, then we can basically say that quantifying exposure is a bit like a VAR problem, except it's much more complex. And the main reason it's much more complex is because the time horizons we're interested in are much longer. So when I quantify exposure, I might be looking at doing it for 10 years in the future, whereas, of course, when I'm doing VAR, the very worst, I'm looking at doing it for 10 days in the future. And added to all the things I mentioned before, like netting and collateral, this means to calculate exposure, we've got a very, very difficult VAR problem on our hands, basically. And that's not the only thing, of course. We have to also look at default probability and try and work out what the default probability is. And there are many ways of doing that, of course, such as looking at historical data from rating agencies or asking ourselves where the credit default swap market is trading at the moment. The really, really important point to notice for CVA is that if we compare credit spreads to historical default probabilities, so we compare the so-called risk-neutral default probability from the market, from a credit spread, to the so-called real-world default probability, which we might get from historical data, for example, we see a very, very large difference, which is characterized by my graph on the bottom left. And what's the difference? Why is there such a difference? Well, that would be accounted for by a risk premium, because obviously if you were a bond investor and you thought there was a 1% chance of a bond defaulting, you don't want to be compensated 1%, because what's the point? You want to be compensated 2 or 3 or 4 or 5%, and that compensates you for the default risk you're taking, and it can compensate you for maybe the liquidity risk you're taking as well. And it turns out, when you look at empirical studies, that risk premium is rather high. So the difference between using a real-world default probability and using a risk-neutral default probability is very large. And it should also be noted that under accounting rules and under regulatory capital rules, the risk-neutral approach is going to become much more market standard. At the moment, there is a big split between banks either using risk-neutral or using real-world default probabilities, or in some cases even using blended default probabilities, somehow a mix of the two. But really everything at the moment, accounting rules, local regulators, and Basel III, is suggesting that you will have to do this in a risk-neutral fashion. And that's basically meaning that CVA is going to be very, very large. Of course, what DVA can do, more or less, is sort of cancel out some of that CVA that you have to charge, and that's why I've put the sort of dotted roll of DVA in that graph. I'm not saying that's a very precise representation of DVA, but just intuitively, that's really what it's doing. It's sort of getting you back to something like a real-world default probability, which is, of course, where you want to be because it gives you a lower number. And indeed, a bank that uses DVA generally would be using the risk-neutral default probability, and a bank that relies on real-world default probabilities generally doesn't look at DVA as well. So it's a sort of either-or. Either I use real-world default probabilities or I use DVA, and they're both mechanisms to reduce my overall CVA costs. Obviously, as I said, practice is generally going to become more towards using risk-neutral default probabilities, but then you have to question, okay, well, why, if that's the case under Basel III, can I not use DVA? Because that seems to be giving me the worst of both worlds. You have to use the big default probability, the risk-neutral default probability, and you have to ignore DVA, and that presumably will give you a rather large capital requirement, and not surprisingly, this will be the case that we'll see in a minute. So, well, I'm not sure if everyone on the call is that experienced with DVA, and I've obviously not had time to define it very precisely, but I thought it might be interesting to just have a quick poll question, which is going to be a bit more complex than the first one I asked. But I'm just asking the question, which of the following most accurately describes DVA? And I've taken 4 comments, some of which I've seen people actually make, or that I've tried to rephrase in my own words, and maybe you don't believe any of these. But the first way you might think of DVA is it's completely normal in economic price adjustment, just like CVA. And some people have expressed this. They've said, you know, DVA is just like CVA. It's pretty normal. We can't replicate or monetize it perfectly, but then again, we can't monetize anything perfectly. So why would DVA be such a big deal? We use it every day. It's in our accounts. It's normal. Or option B, and this has been stated by someone at a large investment bank in the last year, DVA is the single worst accounting standard ever, which seems to express that they don't think DVA is a very sensible thing, which appears to be also partly the view, at least, of the Basel Committee. Or is it C, somewhere in between the two? It's a slightly strange adjustment, but one that a bank cannot avoid using. Trying to price in your own default is a bit weird, but you can't really not do it. Or, of course, D, maybe you don't agree with any of the above definitions. But I think it'd be great if I just pause for a minute and we see what the sort of spread of views on DVA is, at least for those who understand and think they have a good understanding of DVA.
I have launched the poll, and I will give you 10 seconds to answer that. Thank you. I have closed the polls, and we have 34% saying a completely normal and economic price adjustment, just like CVA. 14% said the single worst accounting standard ever. 35% C, a slightly strange adjustment, but one that the banks cannot avoid using, or 17% said none of the above.
Okay, thank you. I think that's an interesting spread, and perhaps that also tells you about one of the problems with DVA. Quite a lot of people seem to agree that it's a bit odd, but it's normal. Some people, quite a lot of people think it is completely normal. A few people think it's just completely crazy. And that's indeed pretty much the view of the market. There are a lot of different views, depending on who you are, depending on your point of view. And I find that feedback very useful, so thank you for that. I'm not going to give my own view, but I suppose I'd probably have to try and sit on the fence and say if I had to state what my view was, it would probably be C. But that's me sitting on the fence, so you can judge what you want out of that. So, okay, well, most people agree or think we might be able to use DVA. So now here's the formula if I take into account DVA. And it shouldn't be too surprising. Basically, I have my CVA term that says what we said before, except now I have to condition on the fact that I wouldn't have defaulted yet, because obviously if I default, then I don't care. So we should account for the fact that if I default before my counterparty, then there's no problem. And then we have this DVA term, which is great because it makes the whole problem symmetric. It means that my CVA is someone else's DVA. It means that accounting standards for someone who makes a loss, someone always has to make a gain, and it means that everyone should agree on pricing. These are a lot of the compelling reasons why DVA should be used. so it offsets the CVA component. But actually, I'd like to just spend a little bit of time looking at the 1 minus PD bit there. And the interesting thing is that this creates a very, very important sensitivity to correlation, because obviously we've got a sort of first to default problem in this equation, in that if I default first, then I don't care about anything that happens later. But if my counterparty defaults first, I can make a loss. So you can imagine two very risky counterparties, both close to default, and depending on who actually gets in there first, it may have a key impact. And in fact, this formula is not always the formula that people use to calculate CVA and DVA. Some people use the same formula, but with the 1 minus PD removed. And one of the advantages of that is then you don't have any sensitivity to correlation, but that might not seem reasonable, because then surely you're double counting. You're saying, well, I can default first and my counterparty can default first, which is surely not the case. So if we do it with the formula I gave, you see in this particular case I've chosen a situation where actually CVA and DVA offset one another for various reasons, and the overall bilateral CVA is quite close to 0. But default correlation is important. That would be the correlation between my default and my counterparty's default. And in particular, if that's very large, we actually, in this relatively simple model, get back to the case where we go back to the sort of standalone CVA number, which is around 250,000 or so. So is that real? That's an interesting case to note. Is that real? Should we really care about default correlation? And this is the last poll I'm going to ask. Quick yes or no. Do you think that default correlation really is relevant for this calculation? Or is there something weird about the graph I've just shown you that maybe it shouldn't really be the case? We shouldn't need to know about default correlation. Maybe you could just quickly say yes or no.
I've launched the poll. You have 10 seconds to answer. And the results are 85% said yes and 15% said no.
Well, that is very interesting. I mean, to give you some feedback, my experience with banks is, I would say, in terms of what banks do, it's more 50-50. So it may well be that the audience we have on the line is biased in terms of region, and that's why we're getting more yeses than nos. But certainly there is a split. I'm not saying that there is a direct answer to this question, but this is a topic that's been looked at relatively recently, and we can argue potentially that the right answer is no. And the reason we can argue the right answer is no is if you go back to the way we define our exposure as the maximum of the future value and 0. When I talk about future value, presumably I mean risk-free value. Now, obviously, risk-free value, I'm not even sure what that means anymore, but presumably that's what I'm getting at. Well, not really. Because if you go and a counterparty actually defaults and you'd have to terminate trades, then you can look at replacement costs. Now, this is when the whole thing becomes interesting. If you're going to replace the trade, then someone might charge you CVA. Well, that's your DVA. So can you therefore go to your counterparty and say, well, actually, I'm not going to pay you what I owe you risk-free. I'm going to subtract my DVA. And indeed, that would be a way of monetizing your DVA. So the people who think DVA is normal, this would be yet another example of how it is completely normal, and it comes into effectively a workout process when a counterparty defaults. So basically we'd say when we're owed money, we will claim more because we want to claim our DVA, and when we're owed money, when we owe money, we will pay less. And indeed, in the case of the Lehman bankruptcy, these sort of practices have been reasonably okay from a legal point of view. If the adjustment there is very, very large, like if I'm saying, you're Lehman Brothers, I owe you $1 billion, but I'm an Icelandic bank, so I can only pay you 50 million because my DVA is so enormous, it's not clear what the courts would view that as, and it may well be that they would reject that. But if it's more like, I owe you $1 billion and I'm only going to pay you 950, then courts have generally shown that they will side with ISDA documentation and allow that. Now, if you put that into the calculation, note, first of all, if you put that into our calculation, it's an absolute nightmare, because if you compare CVA to pricing an exotic option, one good thing about pricing exotic options is we can normally write down the payoff quite easily. The pricing might not be easy, but the payoff often is. here the payoff has just become difficult because this slide here I'm trying to explain the payoff of exposure, which defines CVA. And I'm saying that in that payoff, CVA and DVA themselves will appear. So it's a sort of recursive problem. And I'm not even sure this is right because I really need a lawyer to sort of tell me whether my interpretation of this is correct. I think this is probably the best interpretation, but we almost need lawyers around to really argue about whether this is best or not. So we don't even know our payoff. But let's suppose this is our payoff. Then we get this situation where the blue line is what I showed you before, very large sensitivity to default correlation. And the red line is when I do it with this assumption on the previous slide that the payoff has changed and I can incorporate DVA when my counterparty defaults. And indeed, my counterparty can incorporate their DVA when I default. You get something that's very flat and very close to the dotted line. There's not much correlation sensitivity, which is very nice. And the other thing is the dotted line is what I've called the unilateral bilateral CVA, which is basically what you get if you go back to this formula and you take away the 1 minus probability of default, and that calculation gives you this dotted line at the bottom. That appears to be pretty much spot on with the more supposedly much more complex and more accurate representation. So what I'm suggesting there is if what I just said was true, to a large extent the answer to the question I just asked seems more to be no. Actually, the more appropriate pricing of CVA and DVA might be to ignore my own survival and my counterparty survival probability, and I get a very simple formula. It's not dependent on default correlation, and it's the simplest way to do it. Of course, I should do it in a much more sophisticated way, but that simple formula seems to give a very good result in this case, and in quite a lot of other cases that have been tested. But this is an area that is subject to research. We have a paper out on this. People like Brigo and Marini have also written papers on this. So like a lot of things, this is something where we don't yet have a direct answer, and probably the debate will carry on for quite a long time. Okay, let me briefly talk about wrong-way risk, which is the other thing we really ignored in our CVA formula apart from our own default. Wrong-way risk basically involves looking at the dependence between default probability and exposure, which often is very strong. An obvious example would be buying credit default swap protection. You buy protection on a bank from another bank, and you know if one bank is defaulting, there's a good chance another bank may be in trouble as well, and that's where the wrong-way risk comes in. There is empirical evidence of wrong-way risk. For example, in the interest rate markets, Greg Duffy shows a sort of clustering of defaults when interest rates are low. So that appears to be almost a negative correlation between rates and credit spreads. There's also well-known sort of devaluation of currencies when sovereigns default that was characterized around the Asian crisis and is a lot clearer here. And wrong-way risk is very difficult to deal with because we have to understand that correlation and dependency are not the same thing, and that we might have very subtle situations which could ultimately lead to big problems, such as banks with the losses they face with monolines. We can tackle wrong-way risk in two ways. One is general wrong-way risk, which is what the regulators refer to as the sort of normal macroeconomic relationships, such as what I'm showing in the top graph there is the sort of interest rate credit correlation you might have in a model for wrong-way risk in an interest rate swap. And then more specifically, what I'm showing you down there is the European sovereign situation and wrong-way risk, where even before the crisis, you look at the Italian CDS and you see it's much more expensive to buy protection in dollars, which basically reflects the market telling you that when Italy defaults, or if Italy defaults, then the dollar will be a lot stronger than the euro, so that's why you're paying more to buy protection in dollars. And you can pretty much see, if you look at that then, for that the only way you can really incorporate specific wrong-way risk is to have some sort of jump where if a counterparty defaulted, the FX rate you would be looking at would experience a jump. It wouldn't be a correlation. And that's what I mean about correlation and dependency and not the same thing. Wrong-way risk is often much more brutal than just thinking about a simple correlation between two variables. And it's important to deal with it, but it's a massive problem, and it's going to be yet another area where there needs to be a lot of research, because we really don't have a good understanding of how to deal with wrong-way risk right now. So really, what that all comes down to is when I price CVA into trades, it's a very complex thing, and it can lead to a very large number if I take into account everything. And how do I stay competitive? if I'm a bank pricing a derivative with a corporate, how do I stay competitive? Well, what's normally happened is there have been a variety of ways to do that, using historical default probabilities, including DVA, or just ignoring CVA, for example, for collateralized trades, for very good quality counterparties, and of course generally ignoring wrong-way risk, except in specific cases. Now Basel III is going to change all of this, because it basically says you can't use historical default probabilities, you can't include DVA, and you must take into account pretty much everything. You can't say, oh, we don't think collateralized counterparties are important because we've got collateral. You have to model them, and if they're not important, your models will show that. But if they are important, your models will come up with relatively material capital numbers. So therefore, this thing, CVA VAR, is going to be a big deal. So here's an example of a CVA VAR for a small hypothetical portfolio. And as you see at the bottom, this example was done in collaboration with Quantify Solutions. So thank you to Quantify for these numbers which I'm showing now. There are two ways of computing CVA VAR, the advanced and the standardized method. And you can see here basically a couple of things. First of all, if you look at the CVA number, we're coming up with capital charges which are significantly bigger than the CVA itself. So if you don't think CVA is a problem and you don't compute CVA, well, that doesn't really matter so much, because the capital of CVA is going to come in and almost dwarf that. The second thing is that standardized and advanced in this situation are relatively close. That's not always the case. Sometimes one is bigger than the other. Obviously, you would expect the simpler one, the standardized, to be bigger. That's not always the case. And the other thing to bear in mind is the CVA on the left-hand side here. Of course, I can use DVA as a mitigant to that. Accounting rules allow me to do that. But DVA cannot reduce the two bars on the right-hand side of that graph because it is not allowable under capital requirements. So we see that the capital for CVA is going to really become a key driver of derivatives. Can you reduce that by hedging? Well, yes, you get various capital relief due to hedging. For single-name CDS, you get pretty much full capital relief because obviously you are hedged if you buy protection on your counterparty. For index CDS, well, you've got to model it or you've got to apply it in the simpler formula in a certain way. And I'd just like to note here, and there's some very simple maths to prove this, if you're hedging with an index, you would need the correlation to be very, very high for your hedge to be effective, because you've got to first of all get rid of the effect that you will introduce extra volatility from your hedge. So you've got to get rid of that extra volatility, and then you've got to start reducing the overall volatility. And if you look at that very simple formula I've got there, you can see that, for example, if I want my my capital relief to be 50%, so I reduce my risk by a factor of 2, then I would need the rho parameter to be about 86%. So unless I can have a correlation with my hedges of very, very high, 80% or more, then there's probably not much point in doing it. And so that really requires us to be able to hedge with things that are very, very correlated if they're not the single name. And of course, the single name CDS market is not very well developed. I could also note here that market risk hedges, such as hedging your interest rate risk on CVA or your FX risk on CVA, which structurally are often fairly large terms, you get no capital relief from because they're not included in the formula. So this creates a split hedge issue, which is basically if I hedge my interest rate risk for my CVA, I actually increase my capital. I don't reduce it. And obviously, this is something that banks are particularly upset about, but it's one of the side effects of having a relatively simple capital regime, that you don't capture everything, and therefore sometimes there are unintended consequences. You think you're hedging, but your capital actually goes up. This is a graph that shows you the capital relief you get. Basically, with index hedges, you get moderate relief, and with single-name hedges, you get quite a decent relief, as you would expect, because then you are hedging the actual name and not just hedging with a certain index. So there we come to the fact that the impact of CVA capital charges in terms of the magnitude of CVA VAR, it is comparable to CVA itself, and indeed in my example it's bigger than CVA itself. So even if you think you don't have a CVA problem, or even if you think your CVA is offset by your DVA, CVA VAR apparently seems to be something that comes in as being a very large adjustment that becomes very material even if you think your CVA wasn't material. You can't ignore collateralized counterparties for CVA VAR because they're included. You sometimes have to assume a 20-day margin period of risk, which is going to make the numbers even higher. You have to account for general and specific wrong-way risk. Implications, therefore, well, the CVA charges we pass on to customers if we're a bank, surely they become prohibitive. Do we have to centrally clear everything? The end users are going to find hedging very costly. The corporates or the sovereigns, it's not their fault that we went through this crisis, yet they feel heavily penalized that they can't really hedge anymore because the costs are so enormous. They're not just being charged CVA, they're being charged CVA VAR and other components, and the costs are really, really high. So then the banks also reduce their derivatives businesses, which is a question that is being asked a huge amount at the moment. Of course, it's not a very easy question to answer. I hope personally that the statement there from the economist from quite a long time ago that I've put is one that prevails, but we will have to see. I would just note one thing here, that there are exemptions. So in Europe, the sovereign crisis has precipitated a very likely sovereign exemption for CVA VAR, so you don't have to calculate CVA VAR for your sovereign exposures. That, in some sense, doesn't make very much sense because CVA is very significant for sovereigns. They don't post collateral, which makes it even more important. And so surely you should charge CVA VAR, but of course that would involve the sovereigns being charged higher costs for hedging, and an obvious way to get around that is to give an exemption. There is also heavy lobbying for a non-financial exemption, which would exempt corporates, which would be the other very big component of CVA VAR. And that would actually lead us to say, well, would CVA VAR be important? If we can exempt the sovereigns, if we can exempt the corporates, if we could centrally clear the interbank market, maybe CVA VAR doesn't even become that important in the future. And this is one of the fascinating parts of this area, that sitting here today, it's not possible to answer that question. Is CVA VAR our biggest problem in terms of capital, or is actually a bit of a red herring and things like exemptions are going to take it away to a large degree? I simply don't know the answer. Well, I've covered a lot in a relatively short space of time, and I hope everyone's still awake and not too depressed. But let me just finish with some final thoughts, which are a bit random, these thoughts. First of all, the first thought is technology here is absolutely key. Here's my sort of idealistic CVA system. It does quite a lot. It has a lot of data feeds. The calculation is very sophisticated, and building that is not an easy challenge as you might expect. Secondly, and very differently, risk mitigation is a double-edged sword. We surely have to mitigate CVA as much as possible. If CVA is a problem, surely we can reduce it. If CVA VAR is a problem, surely we can reduce that. And seemingly that's what we're being encouraged to do by regulators. But of course, when we get rid of one risk, we would introduce another risk. And in particular, if you think about the different ways we can trade derivatives, either with no CSA or with a CSA, or with what's called a standard CSA, an SCSA, which is basically a sort of a souped-up CSA, a more rigorous CSA, or of course we can really just go the whole hog to central clearing. I would argue that yes, we reduce counterparty risk when we do that, probably, but we also increase, for example, funding liquidity risk. And maybe we don't want to increase funding liquidity risk. And this graph at the bottom, which I don't have time to go through, which would take a long time, is a quantitative representation of that. And you see the sweet spot, which appears in the middle, is basically saying, don't be completely uncollateralized on the right-hand side. Don't be centrally cleared on the left-hand side. What you want to do is reduce your counterparty risk reasonably with a CSA, but you don't actually want to try and push it to the limit and reduce it too much, because then you just create so much funding problem and so much funding liquidity risk. So that's a simple example, but I'm really trying to illustrate there that CVA is not completely bad, and if we get rid of CVA, what we end up with might be a lot worse. So maybe I'm a little bit biased on this point, but I don't think getting rid of CVA is really the solution to our problems. Finally, I would comment that I've talked about CVA and DVA, and this is really the way we used to price derivatives. If I want to price something very simple and vanilla like a swap, I said simply, well, it's the risk-free valuation and I may discount my cash flows at LIBOR. And then you ask yourself, okay, well, how all the things we've learned in the last 3 or 4 years, how does that valuation change? What would I end up with? And this is my own representation of it. It now looks something like this. I have a CVA, I have a DVA. even risk-free discounting is not that obvious. I have to think about things like OAS discounting. I have a funding value adjustment, which I've represented as an FCA and FBA here, funding cost adjustment and funding benefit adjustment. I have potentially a collateral value adjustment because I have optionality in my CSAs that I may be able to post collateral that's very beneficial to post, as opposed to posting cash collateral, which I don't like to post, for example. And I could go on. I could think of an ATE, which is a termination event in an ISDA language, and say, well, there's a valuation adjustment for that. And I go on. And this, of course, all points to the fact that even to value a very, very simple vanilla derivative is now very, very complex. And we need to consider all of these terms. And they're controversial. First of all, it's controversial. How do I calculate them? It's not clear that there's only one way to calculate CVA. You can use a lot of different models, a lot of different parameters. You see they're controversial in terms of whether they even exist on this call. Some people think DVA is completely normal. Some people think it's kind of a little bit normal, but a bit strange. And some people even think, you know, it's completely stupid. And the same is true of funding, as anyone who's been reading the literature recently will discover. You know, and one of the reasons why I haven't talked about funding today, if you talk about funding, then you seemingly offend a lot of people. You probably have a lot of people who agree with you, but you probably offend a lot of people at the same time. And so a lot of these other terms are important, or are they? So not only do we have to agree, well, which of these terms are really there, and which do we want to price, but we have to actually agree how we're going to price them. So there's a huge amount of work to be done. That all makes it very exciting, of course. Finally, I'm very, very pleased that everyone's listened and dialed into this call. I've only had a limited amount of time, and we will have some time for some questions in a minute, but I would just like to advertise, if you would like to read a bit more on some of the things I've been saying, my new book. But this is the second edition of my book on counterparty risk. As you might guess, writing a second edition of this book was not very easy. It wasn't a question of going through and tweaking a few things. It was really a question of rewriting the entire thing from scratch, because everything had changed so quickly, and of course also inserting a whole load of chapters that you hadn't written before because you didn't know before that funding value adjustment was important, or Basel III and regulation hadn't even been invented when the first edition of this book came around. So some people on the call may have the first edition of this book. If you have, you may be interested in the second one. It is very, very different. And if this is an area that's interest to you, then I hope this book would be very, very useful from that point of view. I think PRMIA will now come on and announce the 3 lucky people, or dare I call them lucky, maybe the 3 lucky people who will have a free version of this book. This book is published in Europe and is available now. In the US, I think Amazon is saying that it's about a month away from being available, but it can be pre-ordered. Obviously, there are 3 people on the call who won't have to pre-order it, and I hope they're going to be pleased with that, but I wouldn't speculate.
Okay.
So I'll leave. Sorry.
I was going to give you the 3 names. The 3 winners are Teresa Ho, Gerald Fruin, and Robert Porter. I will contact these 3 winners via email at the conclusion of the webinar. And then I just want to thank you, John, for sharing your expertise, and thank all who have joined us today. We're going to go ahead now and answer, Alex will answer any or announce any of the questions that have been asked.
Thank you, Anna, and hello, everyone. John, would you deem correct to discount collateralized trades using OIS and non-collateralized trades using LIBOR and calculate CVA on both? Do you think this would double count the risk component for the non-collateralized trade?
That's a very good question to start with. I'm going to go back to this formula. Another important point about this formula is that you could put different things in different places and it would still be correct. So I might think that I want to represent risk-free value with respect to LIBOR, and you might think it's OIS, but we wouldn't necessarily be wrong, because then it's all just a question of what the other terms do. They could all add up to the same number. It's just that what I call one thing is what you call something else. First of all, on collateralized trades, it's easier. It's generally now taken that a collateralized trade should be discounted on OIS, essentially the proxy for the risk-free rate, which is also generally the rate specified in the collateral agreement, which is the more relevant reason why it's used. It's really not so much the fact it's a risk-free rate, it's the fact that in a collateral agreement where you're exchanging cash, OIS is the rate that's paid on that cash, so it appears as the relevant funding rate for the transaction. Now, in a perfectly collateralized transaction, that's correct, and then all the other terms hopefully disappear, and all we do is discount on OIS, and that's fine. And of course, central counterparties have started to do that very early, and then you would think that interbank trades would go the same way. I think that's broadly speaking true, and that's the easier bit. I would just say that, of course, no trade is perfectly collateralized, and we still have a CVA component, even if we think it's small, and a DVA component, and we still have collateral value adjustments, because OIS is only relevant if you're posting cash collateral in the currency of the trade. If the CSA allows you to post more and indeed receive more, then there are adjustments for what I've called collateral value adjustment there. So you would still have adjustments, but they might be small. Now we come to uncollateralized trades, and then the question is, do I discount them on LIBOR now, or do I discount them on LIBOR plus a funding spread if I think funding is important? My own preference, which you may disagree with, would be to really keep it the same. So I still start from valuing the trade on OIS. And then the fact that it's an uncollateralized trade would come into play from the CVA, because when it's uncollateralized, I have counterparty risk, from the DVA, and from the funding adjustments, and from the collateral adjustments. And one of the nice things about that would mean that when I price a swap, when I come up with the risk-free value of the swap, I do not need to know about the counterparty. I do not need to know anything about the collateralization of that trade. All I need to know about is this is a swap, and this is the OIS and LIBOR rate in the relevant currency. And then I come up with what I call the risk-free value. And then, of course, someone has to worry about the adjustments to that risk-free value. But this sort of approach is, of course, very much the way banks have dealt with this whole CVA problem, that you have a centralized CVA function that does all the junk at the bottom and worries about CVA, DVA, and everything else, all these twin brothers and sisters and cousins of CVA. But the trader or the marketer themselves carries on doing the job that they've done for many years, which is they're worried about whatever their underlying is, be it an interest rate swap or a cross-currency swap, and they don't have to become experts in CVA and all these other things. Of course, they want to know about it because they're getting charged by their central CVA desk for CVA and for funding, and they want to know what that means, but they don't need to. It doesn't need to be day-to-day part of their lives apart from being charged that. So that would be my breakdown. I wouldn't necessarily make a big distinction between collateralized and uncollateralized trades, but I would just say be consistent. Start from the risk-free value, which would appear to be the right base case scenario, the sort of idealistic case, and then add on the terms you need. Obviously, from an operations and systems point of view, this is not always the easiest way to do it, and so that may be a consideration as well, but that's my own opinion.
How do you capture correlation between risk factors in case of risk-neutral scenarios, for example?
Yes, okay, so one of the interesting things about CVA computation is that sometimes we use risk-neutral parameters even when we shouldn't be doing it. So this is not the answer to the question, but is a sort of precursor. For example, suppose I wanted to calculate or look at exposure from a risk management purpose, a capital purpose, then I shouldn't look at the risk-neutral drift, such as the forward rates in the market, really, because I don't want the risk-neutral drift. I want the real-world drift. What we'll normally do, though, is use the risk-neutral drift because we don't know what the real-world drift is, and it will introduce all sorts of complexities. So we will just conveniently use the risk-neutral drift, which, in a sense, is wrong. It's not a problem for VAR, because it's only a 10-day problem, and drift doesn't matter for 10 days, but it is a problem for things like CVA, where we're long dated. And so we normally conveniently use a risk-neutral parameter, even though we should really be using a real-world parameter. But of course, we don't really know what the real world is, because if you knew what the drift of interest rates is going to be over the next year, then you should probably go and set up a hedge fund or something rather than doing CVA. So that's the opposite of this question. This question is saying, well, if I want to calculate my risk-neutral exposure and I have a parameter such as a correlation, which I can't go and imply from the market, where do I get it from? And then the obvious thing to do would say, well, we look at the real-world parameters, such as using historical data. So I have a correlation between two currencies. I can't observe the Quanto basket product that would enable, or spread product that would enable me to imply that. So I just look at historical data. Now, of course, that could be wrong. So then I'm going to have a very large correlation structure, and I want to know where my sensitivity is. I want to do a sensitivity analysis and understand, right, is there this correlation here, which I'm very sensitive to, and I've marked it at 13%, which is the historical average over the last 3 years, but that is a very, very important number for my calculation, and I better go and ask myself whether I think 13% is right or not. We don't have much choice because most of those correlations are not implied from the market, and therefore we have to revert to something like historical again.
Do you use the alpha factor to adjust for wrong way or right way risk?
Sorry, can you? I heard the last bit of the question, but not the first bit.
Yeah. Do you use the alpha factor to adjust for wrong way or right way risk?
Yes, from the regulatory point of view, the alpha factor that arises essentially in exposure that goes into Basel II or the CVA VAR formula is the alpha factor, which is generally set at 1.4, is one of the things it accounts for is wrong way risk. So sort of saying you're modeling exposure and stuff, and you're not really accounting for wrong way risk properly. So you need to charge more, and that's what the alpha factor attempts to do. In pre-crisis, although that was said, it wasn't taken that seriously, and I think it's very clear now that post-crisis it is very serious. So, for example, if you're a bank trying to get IMM approval, I think it's probably fair to say, although I'm of course not a regulator, that unless you're modeling wrong way risk, it will be very hard to get that IMM approval. And even if you're modeling wrong way risk, you will then still be at risk to this alpha factor. So obviously wrong way risk has become a much bigger thing over the last 2 or 3 years. And as I said earlier, we find it very difficult to model and to quantify. The alpha factor is a sort of fairly punitive, crude measure of capturing that. Of course, to the extent that you believe that you can capture wrong way risk yourself and model it correctly and price it correctly, then you can make the argument that the alpha factor can be lower. But obviously, the willingness of regulators to do that at the moment is limited simply because proving that you have a very sophisticated way of handling wrong way risk, which is accurate, is not going to be an easy thing to do.
Thank you. This might be a bit of a trigger question, but I think a lot of people are looking for the answer here. In case of bilateral trades, what are the ways in which clients can get their CVA charges from banks they trade with down to zero, especially if they have a better credit rating, for example? And do you think that with Basel III would mean that banks would be compelled to pass on the capital charges for CVA VAR to clients?
I think as far as Basel III and passing on charges goes, it's pretty much a no-brainer. Of course, there's a big debate about whether funding is really part of the equation or not. But for me, there's no debate over this. If a bank is given a fairly substantial Basel III capital charge, then they will pass it on to clients, for sure. And indeed, I know banks that don't even compute CVA I wouldn't consider they really compute CVA very well, but they still put in CVA capital charges to their prices that they show to clients. So definitely yes to that. How can the client deal with that? Well, obviously, if they are uncollateralized, then it's a big issue because essentially that's the problem. If you don't post collateral, then you have to be charged a CVA. Of course, CVA has always been an important component there, and obviously a bank doesn't necessarily want to reduce their CVA by the DVA. If they can just charge the full CVA, they'll do that. So one important thing for clients has been to recognize there is a DVA component and to ask that this DVA component is offset when they're charged for the CVA. And in fact, it's not obviously too difficult to sort of work out roughly what the offset should be. And indeed, for example, software vendors I can recall have produced applications which would allow you to calculate with 5 different counterparties which would be the most favorable price potentially. So almost to sort of imagine in this case that an end user could become very sophisticated and could be trying to work out what their charge should be and really hassling banks about, you're not giving me enough CVA benefit or whatever else. Obviously, you can post collateral, and that's been a very good way to get around CVA charges because although it shouldn't really be the case, if you post collateral, you generally don't get charged CVA. Of course, well, surely you can't because if I'm posting collateral, you can't charge me CVA as well. Well, again, Basel III is going to create a problem here because many banks from an accounting point of view do not calculate CVA on collateralized trades. So, okay, I don't charge a client, but then again, it's not in my accounts, so I just ignore it. But CVA VAR is still relevant for collateralized trades. So even if you post collateral, then it's going to be an issue if you could be getting charged capital because the bank is claiming, I still have to hold capital because you're not posting me enough collateral. You will post me collateral every day, but what about when you default and I have to close out the trades? Well, that could take 2 weeks. And I'm being charged capital for this kind of risk, and so I have to pass that cost on to you. So this aspect could become particularly difficult, and then I think really, unfortunately, I can't give an answer to how you can really improve that, except to remind you of the graph I showed earlier, which there is an optimization here somewhere of, well, what can we do? We can trade uncollateralized, we can possibly post collateral, not sure if it's liquid or if we can sign a very sophisticated collateral arrangement. We can look to centrally clear the trade. Again, we may not be able to centrally clear directly. We may have to go through a bank, and we may not be able to post enough collateral to do that. The bank may have to fund that collateral on our behalf. But you see there are all these decisions that may lead to potential optimization decisions. But there will be no free lunch. Capital charges for banks are going to be significant, whether it's central clearing, whether it's collateralized, whether it's uncollateralized. You add CVA on top of that and CVA VAR, and you end up with a fairly hefty price. And I don't see any way of getting around that, except for the cases where regulations may be given exemptions. So obviously with a sovereign exemption under CRD4 in Europe, potentially, that of course solves the problem for sovereigns. They don't need to be charged now because CVA VAR wouldn't be taken by the banks. So it's the only way to really get around that is to be in a situation where regulators essentially give some exemption, and then the problem goes away. But whilst the problem is there, it is a big problem.
And finally, a question on funding cost. Is the funding cost in FVA a fair value adjustment from an accounting standpoint?
No, it's not. And it's important to note that when we talk about FVA as being a bit like CVA and DVA, we have CVA, and as I said, it's an accounting requirement, so is DVA. We have CVA VAR, which is a very clear requirement. We do not have the same thing from FVA. It is not an accounting requirement, and we do not get charged FVA VAR. So I know of a very small number of banks who are including some sort of funding value adjustment in their accounts, but I think that's more that they are doing it and telling their accountants, we think this is the right thing to do, rather than their accountants coming to them and saying, we think you should be including this. So it's very much, with FVA, it's very much a question of what we think is the best market practice. Obviously, depending on your view of FVA, you could imagine a situation where in a few years' time, we're freely talking about things like FVA VAR as being just as important components, just like CVA VAR. I hope not. But at the moment, FVA for a bank, it's up to you whether you think it's real, it's not real, whether you might think it's a cost, whether it's a benefit, how you want to calculate it. It's completely up to you. And accountants are getting, not surprisingly, very interested in this and have been talked to about, and had a few banks go to them with the FVA that they're putting in their accounts, saying that we think this is the right thing, but we're very much in the early days of this happening. So at the moment, there's nothing you have to do.
Thank you very much for being with us today, John. We apologize if we don't have time to address your questions. And if you have any additional questions, please email John at the email address that you will find in the slides that will be circulated by Anne later. And I'll pass it back to you for the closing.
Okay, thank you, John and Alex. Thanks for sharing your expertise, and thank you for all who have joined us today. Please feel free to go to PRMIA's website at www.prmia.org to find more upcoming thought leadership webinars and information on joining PRMIA as a sustaining member to gain unlimited access to our weekly